Welcome back to the Explainer Focus learners. So I want you to imagine this. What would you do if you had to start building your wealth completely from scratch today? We're talking no existing portfolio, no secret trust fund, just a total blank slate and a serious drive to reach financial freedom. It can feel incredibly overwhelming, right? Well, today we are diving into a brilliant step-by-step blueprint pulled directly from top financial experts on how to start investing in 2026. We're going to map out exactly how you can build unshakable confidence, avoid all those classic beginner traps, and set up a wealth-building system that practically runs itself. And we're going to do it in 7 simple chronological steps. All right, let's jump right into our roadmap for today. We'll be covering 1. Building your financial foundation. 2. Setting goals and accounts. 3. The compound interest snowball. 4. Diversification and automation. And finally, 5. Surviving the market dips. Section 1. Building your financial foundation. Okay, before we ever touch a single stock, actually, scratch that. Before we even think about opening a brokerage account, we absolutely have to stabilize what's happening with our money right now. Skipping this is a massive rookie mistake. Just get a look at this statistic. Nearly 40% of adults cannot cover a $400 emergency without having to borrow money. And honestly, this is exactly what causes new investors to fail before they're even out of the gate. Think about it. You finally start investing, you're feeling good, and then bam, your car breaks down or your boiler suddenly explodes. Life happens, right? Well, if you don't have cash set aside for that, you're forced to yank money out of your investments, usually at the worst possible time when the market is down. You lock in a loss, your confidence is completely shot, and you're right back to square one. And that brings us to a brilliant analogy about the next core rule of your foundation, clearing high-interest debt. Investing in the stock market when you're carrying expensive debt is literally like filling a hot water bottle with a hole in it. The water is your money, the bottle is your investment account, and that massive hole, that's your debt. Credit cards routinely charge you 20 to 40% in interest. Now contrast that with the stock market, say the S&P 500, which historically averages about 8 to 10% returns over the last century. Mathematically, if you're paying 30% in interest just to earn 10% in the market, you are losing money fast. You have to patch the hole first. Clear out that high-interest debt, build up a solid 3 to 6 month emergency fund in a high-yield savings account, and just make sure your daily income and spending are on solid ground. Moving on to Section 2, setting goals and accounts. So our emergency buffer is built, the bad debt is gone, and our financial house is finally stable. The next phase is getting crystal clear on exactly what we're investing for and then picking the right vehicle to get us there. Now, according to the Financial Conduct Authority, less than a third of investors actually have specific long-term goals. Most people just invest because, they hear it's the smart thing to do. But your goals have to dictate your entire strategy. The crucial takeaway here is mapping your timeline to your money. If your goal is short-term, meaning you're going to need that cash in under 5 years for something like a house deposit or a wedding, you must keep it in cash. The stock market is just way too bumpy for short timelines. But for anything medium to long-term, so 5 years or more, you really need to invest it. The longer your money is in the market, the more those short-term bumps completely smooth out. To put the opportunity cost of just sitting on your cash into perspective, check out this data looking at a 5-year window from April 2020 to 2025. The money left in cash grew at an absolute snail's pace, inching from about $1,580 to just $1,714. But look at the same proportionate amount when invested in global shares. It rocketed from $2,666 to nearly $5,000. That right there is the hidden cost of leaving your long-term savings to just gather dust in a standard bank account. Now, I know what you're thinking. How do I actually start? People get totally paralyzed by all the account options out there. But let's cut through the noise. You can basically map your account choice directly to your life situation. If you're employed, look right at your workplace pension, especially if your employer offers a match. Listen, that is literally free money. If you're self-employed, you're going to want to look into a private retirement account to keep things highly tax efficient. And for pretty much everyone else, you want to max out tax-free or tax-advantaged accounts. If you're in the UK, that's an ISA. Over in Canada, it's a TFSA. These accounts act like a shield against taxes, meaning all that beautiful growth stays entirely yours. All right, Section 3, the compound interest snowball. We've got our foundation, our goals are set, and our account is open. This brings us to the absolute best part of wealth creation, the math that lets your money do the heavy lifting for you. A recent survey from Barclays found that 44% of people hold off on investing just because they don't know how, and another 41% are literally terrified of losing their money. But look at the step-by-step math. It totally proves that you do not need to be rich to get rich. If you invest just $100 a month into a market index, like the S&P 500, earning that historical 8 to 10% average, and you just let those returns earn their own returns, well, that's compound interest and it's pure magic. After 30 years, you will have put in just $36,000 of your own cash. But your account balance? It will have snowballed into over $140,000. That is over $100,000 in pure profit generated by the system simply because you started small and stuck with it. Which leads us perfectly into Section 4, diversification and automation. So, how do we make sure that snowball keeps rolling and, more importantly, doesn't melt if one specific company or industry suddenly takes a nosedive? We diversify. Think of diversification exactly like a balanced diet. If you only eat pasta every single day, you're going to feel sluggish and terrible. Investing is the exact same way. If you dump all your cash into one trendy tech stock or some new crypto, sure, it's exciting, but it's wildly unstable. Instead, using an index fund, like that S&P 500 we talked about, automatically spreads your money out across hundreds of the biggest companies in all sorts of sectors: tech, healthcare, finance, energy. You don't even have to guess which sector is going to win. By holding this mix, the big winners naturally offset the losers, giving you steady, reliable growth without all those sleepless nights. And speaking of sleeping soundly, you've got to hear this. Fidelity once did a study, and they found that their absolute best-performing accounts belonged to people who had either completely forgotten their accounts even existed or had sadly passed away. I know, it's kind of hilarious in a dark way, but it highlights the ultimate, undeniable secret to investing: doing nothing. Once your account is set up, just automate a monthly transfer to trigger right after payday, before you even have a chance to spend it. Automation completely removes your willpower from the equation. It stops you from tinkering with your portfolio, and most importantly, it takes all the emotion out of it. Your system just buys, month after month, whether the market is up or down. And our final structural pillar, Section 5, surviving the market dips. We have to talk about every new investor's absolute biggest fear: market crashes. It's the one hurdle that makes people panic and sell at the absolute worst possible moment. Because, let's be real, when you open your app and just see a sea of red, it feels like the world is ending. But some data from Morningstar offers some serious perspective here. Over the last 150 years, the stock market has crashed 19 times. And you know what? Every single time, without fail, it has recovered and gone on to hit new all-time highs. Look at this timeline. The Great Depression, the dot-com bubble, the 2008 financial crisis. Were they brutal? Absolutely. But the market always bounces back. Case in point, the 2020 COVID crash. It took just 4 months to fully recover, the fastest bounce back in history. When you zoom out like this, it completely reframes those terrifying red dips. They aren't catastrophes. They're literally just tiny speed bumps on a long, inevitable climb upwards. The takeaway? Patience is rewarded and panic is punished. So let's bring this whole shebang together. Here is your final blueprint checklist, the 7 steps we covered today to take your blank slate and turn it into a wealthy future. Number 1, clear out that high-interest debt. 2, build that emergency buffer so you can actually sleep at night. 3, figure out if your goals are short-term cash or long-term investments. 4, open the right tax-advantaged or employer-matched account. 5, start harnessing compound interest by investing even small amounts consistently. 6, diversify your investments using index funds. And 7, automate the whole thing and stay incredibly calm when those tiny speed bumps happen. I want to leave you with this final provocative thought. What is the single financial goal, or maybe the single fear, that is currently stopping you from taking your very first step today? Because as we've seen throughout this explainer, you absolutely do not need a 6-figure salary or some fancy finance degree to start building wealth. The steps are totally clear, the math is proven, and the tools are sitting right there on your phone. The honest truth is, you're going to learn the most just by diving in and doing it. But the biggest risk of all? That's doing absolutely nothing. Take that very first step, build your foundation, and let time do the heavy lifting for you. Thanks for hanging out with me on this explainer, Focus Learners. Now get out there and start building your blueprint.